This is on the move on Yahoo Finance. We are seeing stocks rally today, particularly the NASDAQ, which is up better than 1%. But another asset that has gotten a lot of attention recently has been the US dollar, which has been trending lower. Tom Essayes is joining us now, Sevens Report founder and president. Tom, a lot of implications when you see a US dollar movement like we have seen, including it being good for companies that get a lot of their revenue overseas. What are the implications that you're watching most closely?
Sure. Good afternoon, guys. The dollar is very quietly gone down to a 2-year low. Most people don't realize that, but it's also what's been pushing gold up. And in the short term, you're absolutely right. The benefits are to corporate America in the short term, because that is going to be a tailwind on earnings, and that's supportive of the markets. Longer term, though, kind of one of the discussions that's really starting to appear is, are the currency markets starting to protest a bit towards all this stimulus? You know, we're in the midst of this stimulus negotiation. It'll probably take another couple of weeks. Is all of a sudden the currency market saying, look, the U.S. is doing too much, and are they punishing the dollar? That's sort of a bigger question, and it has some pretty substantial ramifications if it keeps going.
Tom, it's Julia LaRoche, and thank you so much for joining us. And I'm glad we're having this conversation about the downward trend in the dollar. Help our viewers, a lot of them are retail investors, understand some of the ramifications here as it relates to that.
Sure. So as the dollar goes down, it'll put upward pressure on inflation, right, over the longer term. Now, the last time we saw a dollar really kind of get hit hard, if you guys all remember the fiscal cliff, right, of 2011, the dollar index, which is currently trading around 93, got all the way down to 80. That can actually cause a fair bit of inflation to the end user, to those of us going to the store buying things from China. And so that's kind of the real world implication. From a market standpoint, it could put upward pressure on interest rates. And I know that's something nobody's talking about right now. It's not going to happen in the near term. But over the longer term, if the dollar can't recover, and if the global currency markets say, hey, that's it, the U.S. deficits are too high, the debt is too high, we're punishing the dollar, then that means higher inflation, higher interest rates for the U.S. consumer in the years to come.
In the years to come, but right now, I mean, we enjoy being the reserve currency. And this issue with gold, when Goldman Sachs said that gold would hit $2,300 an ounce, I was reminded of when they said oil would be $200 a barrel back in 2008, and it never happened. Are people overblowing this fear run to gold right now?
Well, I don't know if they're overblowing it. And look, the last couple of days, gold is up, kind of gone a little bit parabolic. So is it due for a pullback? Maybe it comes after the Fed? Sure. But if you step back, really, the gold has been rallying because the dollar's gone into kind of mini free fall here over the last couple of days. And if that continues, can gold trade through 2,000 an ounce? Yeah, I mean, it probably will. Gold trends incredibly well, and the trend right now is up. But at the same time, if you're buying gold here, you've got to be pretty confident that what we've seen over the past couple of weeks is going to continue. And that's, coronavirus problems in the U.S. and a very relatively stable situation in Europe. I'd be watching those European numbers, because if all of a sudden they see a rebound in coronavirus the same way we have, this currency trade will unwind in the short term. Again, the bigger issue is U.S. deficits and debt. But for now, it's really looking at the two economic recoveries, and the EU is doing better than the U.S. right now.
Jared?
Hey, Tom. Jared Blicker here. Always good to speak to you this time in the middle of the day instead of in the early morning. But I wanted to get your latest take on interest rates. I know I ask you about this all the time, but specifically the 10-year is still below 58 basis points. There is no alternative except for maybe these growth stocks. How does this fit in with your picture along with the dollar?
Yeah, it's for those of us that have been in this business a long time and have looked at interest rates really as a pretty reliable gauge of future growth and inflation, what we're seeing from interest rates is really kind of concerning. Now, I know that people will say the Fed and global central banks have distorted the market, and they're probably right. But at the same time, you can't ignore the fact that the 10-year yield cannot go higher. Now, we can argue whether or not it should be at 150 or 1% or even 90 basis points. But the fact that the 10-year yield just goes relentlessly lower when stocks are essentially pricing in sort of somewhat of an economic recovery is really a big dichotomy in the short term. And by the short term, I mean the next 2 quarters into year end. And that has to resolve itself. Either stocks are right and the economy is going to catch up either through stimulus or through natural waning of the virus, or the 10-year yield is right, and we're stuck in a slow growth economy for a long time.
And we'll just have to wait to find out which is right indeed. Tom Essaye is Seven's Report founder and president. Thank you so much for hopping on and giving us your market perspective. Appreciate it.
Thank you, guys. Have a great day.